Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our commentary on economic events and their potential market impacts. Let's get started. So let me apologize in advance for this week's video because there's going to be a lot of numbers in it. But when you're talking about the U.S. budget and the deficit and the total debt burden of the U.S. Economy, there's no way to get around talking about a few numbers. Now, why do we think now is a very, very good time to talk about the budget deficit and the financing of that budget deficit? Well, this past week, progress was made, tremendous and even unexpected progress on a bipartisan infrastructure bill that intends to spend $1 trillion over the next 10 years, improving our roads and our internet access and so forth. All right, that's one big thing that's in the news that has big implications for debt and deficits and so forth. Second thing, as soon as this infrastructure gets passed, the Democrats are wanting to pass with just Democratic votes because it's going to be a budget bill, and budget bills only need 51 votes or 50 votes with a tiebreaker from the vice president in the Senate. They're talking about a $3.5 trillion quote-unquote infrastructure bill, although it's got a lot of things like child care and so forth that a lot of people don't consider infrastructure. But the bottom line is queued up in front of Congress is $4.5 trillion worth of spending over the next 10 years. Or just to do the math for you, $450 billion per year for the next 10 years. That's serious money. And another thing that came out in the last few days is Federal Reserve discussion of potentially tapering their purchases of Treasury bonds and mortgage-backed securities. Now, anybody who's been watching our videos know that we've been talking about pretty much so nonstop since we started them about the Fed's money printing press and the fact that they have been buying an awful lot of U.S. government bonds and mortgage-backed securities that are helping finance these giant budget deficits. Well, the Fed is starting to get really serious about talking about when can we shut down the printing press. And some are even talking about maybe by the end of this year or early in 2022. So this seems like a really good time to talk about they're adding a lot more potential spending, and the Federal Reserve's talking about no longer creating that free lunch of the printing press to help finance that spending. What could that mean for financial markets? All right, first of all, a little bit of full disclosure. If you talk to any Democratic congressman and some of the Republicans who helped negotiate this deal, it is paying for itself. It's not going to add to the deficit. What are you worried about? Now, the Congressional Budget Office, the accounting types who are actually responsible for looking at these bills and deciding, do they really pay for themselves? Are there enough revenue sources and tax increases in this bill to pay for $1 trillion worth of spending? And they pretty much so came up with, no surprise, no. There's some smoke and mirrors in there. Roughly say 2/3 to 3/4 of this proposal is actually funded, which leaves about, $250 billion, $300 billion, somewhere in that neighborhood that you got to come up with the money for, because it ain't going to be paid for inside of this bill. Let's assume that number holds true for the infrastructure. This bill has not been passed yet, and CBO has not scored it. So we don't know what this might look like, but I'm going to say probably a pretty good rule of thumb that about 1/3 of these bills are going to be deficit financed, because that's pretty much how the government's been running for a lot of the last 20 years. They spend $3, they raise taxes on $2, and they borrow $1. That's kind of a reasonable ratio. So what does that mean for the deficit? Well, they want to spend an extra, give or take, $450 billion a year. And using that rough rule of thumb, that means the deficit goes up maybe $150 billion, maybe $200 billion, something like that. Why do we care? Will it matter? Well, let's take a look at the history of the U.S. government borrowing for the last 20 years or so. and kind of put 150 or 200 billion of extra debt every year, bigger deficits, in some kind of context. Now, I didn't even bother drawing this line in because it's kind of hard to even remember, but there was a time back in 2000 and up until we invaded Iraq and Afghanistan, we actually ran a surplus. But it might as well be ancient history because those days will probably never come back. Starting around 2003, we ran deficits. And when the housing crisis happened and we had to bail out banks, there was huge collapse in tax revenue, we had to give lots of unemployment benefits, there was all this stuff we were spending on, the deficit exploded to about $1.4 trillion. Right? We had never seen a deficit like that in our lives. And that's what President Obama kind of came into when he came in office. And we ran $1 trillion deficits for the next couple of years. Then something happened. They lost the House of Representatives. The Republicans took it over. And from then on, President Obama and the House of Representatives couldn't agree on anything. And if you can't agree on what you're going to spend or what you're going to raise taxes on, guess what happens? If nothing happens in Washington, deficit tends to go down. Which is, that was actually, this is the most epic and historic reduction in the annual deficit that we ever saw from about 2011 to about 2016. President Trump inherited a deficit of about $400 billion. But he also got a Republican Senate and a Republican House. And what happens when Congress and the president can agree? They start running massive deficits. And lo and behold, the deficit exploded under President Trump. All right, now I'm going to skip over this, but we're going to come back to this important date of September 2016. The deficit is exploding. It's on track to be about 1.4 trillion. And then what happened? Well, we all know what happened. COVID. An unprecedented collapse in tax revenue. Unprecedented expenditures. PPP loans to help businesses stay afloat while we're basically shutting down the economy, trying to contain this pandemic. $3.1 trillion deficit in 2020. But don't worry, it's going down in 2021. Biden administration has come in and they have cut the deficit to $3 trillion. So we're going to have 2 years of epically huge, unbelievable, catastrophic deficits. All right, now, based upon the CBO's projections though, tax revenues recovering fast. We're not going to do any more extended unemployment. A lot of the PPP loans are a thing of the past. A lot of this expenditure is in the rearview mirror. And the CBO thinks that the deficit is going to improve to thereabouts $1 trillion. And it'll be at $1 trillion. And by the way, this is before the infrastructure spending. So just keep that in mind. About $1 trillion. And then it explodes again as the last of the baby boomers start retiring and we go back to about a $2 trillion deficit. All right, these are obviously projections. All right, now, 3 things I want you to take on board about this graph. All right, first of all is, do you notice a trend here? The deficit situation gets worse and worse, and there's a demographic reason for that. More and more people are retiring, Social Security, Medicare, and there are fewer and fewer workers paying the taxes to pay for those benefits. People think, well, I paid Social Security my whole life. I paid for Medicare my whole life. Didn't they save the money? No, they didn't. All right. So basically, this is one of the reasons why this trend looks so ugly. And we are now sitting in a situation where the total U.S. debt is about $28.5 trillion. Thanks to this little $6 trillion borrowing binge, it exploded from being about the size of our economy to being about 25% bigger. All right? This is not a trend you can keep going with. Most people agree. All right? And then you ask, well, how did we get away with it? How could we possibly have financed all of this borrowing? And how could we have possibly had our stock market go up and interest rates go down and be able to actually get mortgages for under 3% when there's this epic binge of borrowing going on? Well, the answer is 9/2016. On this date, the Federal Reserve, notice COVID hasn't struck yet. But what's happening is the budget deficit is exploding. And the economy's doing great. People are buying houses. They're buying cars. This was the Trump economy that everybody was so excited about. And the problem is that the Federal Reserve printed a boatload of money to help this borrowing binge happen. All through here, they weren't printing money. And because the economy is healthy, you're supposed to print money when the economy needs help. The economy didn't need help, so the Fed wasn't printing money. Until September 2016, the budget deficit's getting to such a huge amount. At the same time, people are wanting to buy cars and buy more. So everybody's trying to borrow money. The US government's trying to borrow money. Homeowners are borrowing money. Car buyers are borrowing money. And that's what happens in that environment, is there was more people trying to borrow money than there was money available in the economy to borrow. When that happens, the price of borrowing goes up. The price of borrowing, interest rates. So interest rates were threatening to explode upward in September of 2016. A key part of the bond market called the repo market, interest rates hit 10% one night. Now, the Federal Reserve, under tremendous pressure from President Trump, said, well, I guess we got to do something. We have never, ever, ever printed money and bought government bonds and helped finance a huge deficit unless the economy was super weak or we were fighting the Germans and the Japanese. But the Fed said, well, gosh, look at the awful things that President Trump is saying about us on Twitter. We better crank up the printing presses. So they had cranked up the printing presses before COVID hit. So that when COVID hit, the presses were already warm. The Fed was already, ready to accommodate this huge binge of borrowing. And that's what they've been doing ever since. They've been running the printing presses. They've been they've been buying the bonds that the US government is issuing and help finance this huge binge of borrowing. All right. What does it all mean? Why do you care? All right. Since about September of 2019, the U.S. has net borrowed their total debt. So net of, some goes into the Social Security reserve, some goes here. But net, the total debt burden of the U.S. has gone up by 5.5 trillion. All right. The Fed has printed and purchased 4.5 trillion in government obligations. So for the last 2 years, despite the huge explosion in government borrowing and in government debt, why could the market go up? Why could interest rates go down? Because the US government was only net borrowing about $1 trillion. And since this was 2 years, only about $500 million a year. Our markets can absorb that, all right? But we're going to be borrowing $1 trillion, and maybe on top of that trillion, another 150 to 250 billion. So let's say it's going to be 1 to 1.3, 1.4 trillion. If the Fed stops their printing presses at the end of the year or in early 2021, as they were talking about at the meeting they just had, then instead of the market having to come up with $500 billion, they're going to suddenly have to come up with $1 or $1.5 trillion to fund government borrowing. And that's despite this huge drop in the deficit, because we're not going to be doing PPP loans and extended unemployment. Despite that huge drop in the deficit, if the Fed ain't helping, then the amount the market has to finance could triple in the next 12 months. Now, the good news is that Americans are sitting on unprecedented amounts of savings. A lot of the stimulus money and so forth, nobody spent it. They just put it in the stock market or they put it in their savings account. A lot of savings are sitting out there. So it may be possible we can triple this number and nothing bad happens. But if the Fed keeps talking about winding down their printing press sometime in the next 12 months, then at some point, I suspect, and it may be that it won't happen until they really shut down the printing press and we find out just how hard it will be to finance 1 trillion or 1.5 trillion without Fed support. But at some point, if they really do shut down the printing press, I think markets are going to have a problem. I think we all need to be ready for that. And the markets that are probably going to have the biggest problem is going to be the bond market. Right now, 10-year Treasury only yields about 1.2%. You're lending to a government that's got this much debt sitting on an economy this high, this big, and you're only getting 1.2%. So if there's a market that's going to have the biggest problem, if we go from funding this to funding more like this, or even more, I think it's going to be the bond market, and I wouldn't want to be there. Thank you for joining us for Market Insights. We hope you found it informative. If you did, hope you can like the video and share it with your friends. Also, you can find more of our research at www.caravelconcepts.com. Thanks.